All right, welcome. Happy Saturday, everyone. Welcome back to another episode of Lambert's Moneymaker, where we talk about everything real estate, how you can benefit from real estate, all the different nuances in real estate, anything real estate you can learn here and implement these strategies into your business to make money and cash flow. Today, we have a special guest with us, a friend, a partner of mine, Chris Craig from Las Vegas. He's going to be talking about tax strategies and how we could utilize tiny homes to get massive depreciation and bonus depreciation on our taxes to save money from having to give it to the man. So, without further ado, I'll bring up Chris and we will start the episode. Chris, what's going on, my man?
Good morning, Aaron. Thanks for having me on.
Yeah, absolutely. So,
It's always exciting to be able to educate people or the masses on tax strategies because I think, I'll just say there's people that love to pay their taxes and could care less about reducing them. And you know what? We live in America. That's their right. So if you're like me, I'm looking for strategies all the time. Just like you, we're always looking to reduce that burden of what check. I mean, because when you're stroking six-figure checks and you got a family and kids, and you're like, I'm going to be stroking this check every year for the next 10 years.
nope.
That's like $1 million, you
Yep. I
know?
already know. I pay.
It's
I
like,
pay. I gave the man a lot in 21 and 22. Yeah.
so,
I
you
want to be like
know,
our former president Donald Trump paying 600,000 or $600 in federal taxes because
on,
he
on a on a billion three in income or
yeah
something, right?
yeah because he knows what he's doing. He utilizes
Well,
tax.
and how that's done, I mean, I just say, look at Pace. Pace is not paying, he's not stroking a check. He's
Oh, I know.
because he's got RV parks, multifamily. Um, RV parks are a good lead into tiny homes. Like if it's an RV park, you can first, tiny homes are also considered RVs.
Right, mobile.
They're mobile, and most of them
Right.
have an RVIAA cert or an NOAH cert, which then classifies them as RV tiny home. Like this is a broad area. But anyway, the reason why Trump and the big boys that make lots and lots of money don't pay income taxes, it's not because they have like losses or they're losing revenue. It's because the tax code allows certain things sounding in when you buy assets, they're utilizing purely depreciation because when you utilize depreciation for tax planning, it still allows you to it gives you the ability to be bankable as well. And
Yeah.
what I mean by bankable, not that you just go open up a bank account, banks will still lend to you when you have expenses, and it's a common thread with the typically college educated CPA that's probably doesn't even have an MBA or even a master's in taxation. They don't teach in college because I went the whole accounting track in college as well.
Yeah.
Um, they don't
Well,
teach
Chris,
tax plan.
before we get too deep into detail, let's give the audience, because this is going to be broadcasted, people are going to watch this. Give an audience a little bit of background and expertise in tax strategy, particularly for investors, just a little bit, and then what made you explore tiny home investments as a tax strategy? Because as we know, as we're here right now, my mind was blown as to the advantages of this particular strategy that we're going to be discussing on this episode. So if you
Okay, so my background is I was a late bloomer. I didn't go to college till I was like 31. I was in the Marine Corps for 4 years active duty, 4 years in the reserves, worked in tech, mostly telephone companies. And then I got into distressed real estate in 2000, 2001 after the dot-com crash. I've been in the distressed real estate space ever since. And then say 2009, when we kind of saw the crash, the larger residential crash, my hand was caught in the cookie jar. I had rental property. I was basically losing it all because it was, upside down 200%. Like, what do you do? Prior to that, like from say 04, 05, I moved to Las Vegas in 04. I started basically, I was, had some money behind me, was buying, foreclosures at the auction. And then when the hedge funds started moving in, and you had to have a lot of capital margins, you used to be able to go buy a house at say 75%, 80% at auction. Hedge funds moved in, and they were bidding these things up to 90, 93% of fair market value. Small guys like me just couldn't make a living. So then I started doing surplus proceeds, made a few $1 million doing that.
Which is a big opportunity that you have for others right now.
Right now, it's coming back. I mean, I just watched a property get bid up here in Las Vegas. I'm going to go see the guy sometime today, but it's a $200,000 surplus proceeds case,
Yeah. We won't go
So
too in deep for that one because we can go down a rabbit hole on that. But
yeah, so we went. So I went and hired an attorney. They were the largest law firm that worked for Bank of America Countrywide at the time. I hired them as my attorney to go get surplus proceeds cases. So then when their primary lawyer, Steve Yarmy, in '09, he went out on his own, reconnected with him. I started working for him as a paralegal, and then I got my MBA. And then right after my MBA, I went to law school. And so while I was going to law school, I was working for a law firm, and I worked for him, for like 15 years, man. So I got the whole legal education while got my education in law, but the practical, experience. I've been in, settlement conferences with federal judges chambers, state court judges. Mostly we practiced, in his firm, it was real estate law and bankruptcy, Chapter 11 bankruptcy. So that's where I got my expertise there. But then I got my master's of law from Thomas Jefferson School of Law in San Diego in taxation. So business bankruptcy and taxation. So in 2018, I started my tax firm. It's basically, I call it the tax firm. And I've probably, I've gone to like 3 different certification courses. Each costs like 25 grand a piece to learn tax planning, because you can't go to college to learn tax planning. You can't go get your master's degree in taxation and learn tax planning. All that the master's degree teaches you is tax code. That's it, tax code and tax procedure. And that's important when you're dealing with the IRS, because if you miss in tax law, if you miss a procedural date, you lose. That's it. There's no coming back. It's all administrative law, and it's based on administrative procedure. So if you miss a step in the procedure, sorry, you lose. That's it. There's no taking it to court and say, this is not fair. The court's going to say, you missed the procedure. We have no jurisdiction. But anyway, so basically, from the tax planning perspective, there's a lot of strategies out there. There's oil and gas. There's this, there's that. There's charitable gift financing. There's charitable LLCs, which is a big one that Zuckerberg used to take appreciated stock in Meta and move it into this other thing. And I mean, tax professionals are never, I'll just say in my experience, they're never confident about telling you about a strategy if they know nothing about it or have never taken a class or a course on the strategy.
Right. I could talk firsthand to that, because I had my tax CPA that I was using, I don't know, maybe 5 or 6 years ago. When I started getting into real estate, I was asking him questions. I was, YouTube University, trying to learn as much as I can. I had read a bunch of books on tax strategy, like from like Rich Dad Poor Dad and some other stuff, some of his people that he deals with. But I started asking my CPA about stuff that I was learning in these books and online. And he was like, he didn't have any questions. He's like, well, what are you talking about? I'm like, okay. I went and found somebody.
You're not going to know, because it's like you have to invest in yourself and your education in yourself. And CPAs go to school to learn accounting, generally accepted accounting principles, and procedural and compliance, and that's what college teaches them. When you study for the CPA exam, which I did, it doesn't teach you how to reduce your tax burden. It doesn't teach you that at all. It teaches you compliance, rules, and regulations. That's it. It doesn't give you tricks. So most accountants, I have got family members that are CPAs. I talk to them, hey, why don't you start doing this for your small business clients? And I get, what's that?
Yeah.
Well, sorry, but that's probably 80% of your accounting professionals out there are exactly educated in that way. So anyway, fast forward, I go to seminars. I probably spend another $100,000 a year just on coaching, on
Yeah.
strategies. Basically 2 day seminars that can cost $10,000, $15,000. Sometimes, it could be online or whatever like that. But I go to networking events. I'm talking to all these other professionals because, hey, look it. I might not be an expert on some of these other tax strategies, but I have resources and I'm going to rely upon somebody else that might be an expert in that strategy. And I'm going to refer that guy some business. Right.
Yeah.
So I guess 3 years ago, 4 years ago, I got into this tiny home strategy. And because it's no different than, say, a manufactured home, which is a manufactured home, AKA mobile home, right?
Right.
There's a tax court case. It's called Shirley versus Commissioner. And this really set the law on the different, and the tax court case is from 2004. So, it's 21 years old, but that's what we would call a relatively new case, even though it's 21 years old. It's not like 1960 or 1920.
Right.
What it says is if you use a manufactured home or any sort of movable property that's not considered real estate for a short-term rental or a rental term of 30 days or less, you can write the purchase price 100% off in the year of purchase. If you
Right.
use that same house for long-term rental, then it converts it to basically a 27.5 year depreciation period. So with modular, so you typically, it's the STR loophole. You're going to rent it out for a year for short-term for the first year, then you can convert it to long-term if you want. But
Right.
here's my point. In the right location, because tiny homes are small, they're easy to get to places. You're not got this big long 80-foot mobile home that's by 16 feet wide that's got a little bit harder to get into down some dirt roads. Most tiny homes can just fit on, they're like 8,000 pounds. They can fit on a flatbed trailer, like almost like a car hauler in a way. And you can get them into some really nice remote spots. Granted, you need your utilities and all your hookups, but you can go off grid with them. The beautiful thing is I've seen some people that have bought tiny homes from me and located them on their land. Some
Yep.
of them are getting $700 a night for a tiny home stay.
Yeah, I believe it, especially for like work related things, or like in remote locations like we were talking about, like Utah, or just like some nice little destination spots. But before we start talking about that, I want to like just a brief overview. I named this podcast Tiny Solution to a Big Problem because we're speaking on tiny homes and taxes. What exactly is that? Just a brief overview of buying this tiny home and what it's going to uh, be for the investor or whoever buys this. I know we touched on a lot of points bringing up to this point, but I want to just try to, in a couple sentences, what is it that we're going to be discussing today with the tiny homes? Because I know you just brought up the tiny homes, because that's really the whole big thing, the big picture.
The biggest point is when investors buy tiny homes, you don't necessarily need to have the land. Partner with somebody else that has already got the land and let the investor buy the tiny home. The investor buys the tiny home, puts 10% down on it, leverages the other 90% with, say, dealer financing. So I'll give you in my terms is we look at location. Where's this going? Let's look at what we can get for an average daily rental rate. And if it's one of these locations near a national park or wherever it might be, okay, well, we'll sell that home in kind of your, look, we got a location for you. So we can sell that home, gross it up, give you 10x leverage. So basically, you put 50 grand down and get a $500,000 deduction.
Right.
So that deduction comes through the tax code called Section 179 accelerated depreciation, which right now that we don't want to ever use accelerated depreciation. That's a bad depreciation strategy for at least this year and the next 4 years, because Trump brought back bonus depreciation under Section 168K, which doesn't require an investor that is already, a doctor or a dentist that are already, inundated in their own practice. They don't have time to manage something, right? So this is a perfect fit for somebody looking for the tax deductions that's already running a business. They don't have time. Utilizing bonus depreciation does not require material participation in that business. It only requires active participation.
This plan right here is ideal for this tax code 168K, and what we're discussing is ideal for people that aren't necessarily real estate investors but make large sums of money in their practice, whether it be attorneys, just other entrepreneurs, business owners that are doing whatever they're doing outside of real estate, doctors, those type of professionals. Correct?
Correct. Even high wage earners, high W-2, like tech workers. Some of these guys make $1 million+ a year. I have clients that are doing $2.5 million a year on a W-2, and they're utilizing the tiny home strategy to zero out all of their income. Zero.
We like that.
So
we like
I'll give you an example of a client I just took on. I just took on some more, UFC fighter clients too. $2 million a year in income. They're going to come out of pocket like $200,000. That's the down payment. And they're going to zero out their tax bill. So they would owe about $800,000, but instead they put $200,000 down, and they're not going to have to pay that other $600,000 to Uncle Sam because of the depreciation strategy. The depreciation eliminates under 168K, your capital gain, your passive income, and all of your active income, whether it be W-2 or business income from an LLC or S Corp or anything, or even a C Corp.
That's perfect. So talking a little bit about the money down and the deduction. So we had previously spoke about an investment of $200,000 for one of the duplex models that they have. And I was running some quick numbers, and it was from what I gathered and what I remember from our conversations was on this type of investment, you're going to get about a $1.5 million deduction. Is that correct?
That's correct.
So if we do, what is the ROI on that?
Well, you're focusing on your ROI is not so much your ROI is, let me just keep the number at 2 million for intents and purposes, right? But if you had $2 million of taxable income, you're in a 40%, 40.8%, just call it 41% tax bracket. That's $820,000, right?
Okay, so let's use
so
that.
If you put 200 down,
yeah,
you don't have to pay the other 620. Your ROI is like 400%.
That's crazy,
right?
That's
now, the lower amount of income. Here's another beautiful thing. You don't necessarily have to be $1 million income earner. If you're earning 500, maybe even 250,000, you can also buy these things in fractional ownership, like in our co-ownership agreement. So 4 people, 5 people, 6 people, 8 people, you can put your 25 grand. The lower amount of money you make, obviously the less tax burden you have, but even for the $250,000 income earner, 25 grand will wipe out your income taxes. And you're getting like a 80 to 100% ROI because you're typically going to pay like 40 to 50 if you make 250. So 25 grand negates the other 25,000. So it's.
So let's talk about that, because that brings up another point that I have is the structure. So specifically, well, let's just go on. If you're just a sole guy and you got your 200 and you want to bring to the table or more, what's that structure look like? And then I want to touch on what the structure look like if we're doing a fractional type thing.
So typically, I have the tiny home dealership. It's licensed out of Texas because the majority of the manufacturers are in Texas. So it was easier to get a license in Texas
and Utah. They have out there.
Well, there's a manufacturer in Utah, but once you're licensed, you can buy these things. There's really no regulation on tiny homes. There's a couple manufacturers that manufacture tiny homes or smaller mobile homes, right?
Yeah.
And if you go above the 400 square feet and call it a mobile home, the advantage of having a mobile home or manufactured home is those are HUD sealed or HUD stamped, meaning if the shit hits the fan, you can always pivot and Section 8 rent those ones. Tiny homes, you can't Section 8 rent a tiny home because they're unregulated.
Right. Yeah.
Mm-hmm.
They don't meet the particular
Hold on
criteria.
1 second.
Well, guys, while we're waiting on Chris to finish his call, I do want to stop in here and say if y'all have any questions about this particular tax strategy and are interested in investing in it, I have a link below that is going to allow you to book a call with us, so that we can answer more detailed questions about this particular strategy and how you could benefit. This year, we have a short window to capture this year's tax or income, but there's implementations that we can put in place for next year, if you are foreseeing that you're still going to earn the same amount of money next year or more. So let's bring Chris back up. Chris, are you back?
All right, we're back. No, kiddos got cavities. They need to freaking do them right now. So
Yeah.
that's that.
That's your daughter?
Yeah.
I got it. Got it. Okay. Structure. We're talking about structure for the sole investor.
So structure is you form an LLC because you don't want to sign for debt when you leverage these things out personally. So it's dealer financing, 10% down. The rest is 90% financed by like my dealership, right?
Got it.
So that gives you the leverage you need. So you're going to form an LLC, buy the asset under the LLC. That structure then, from a tax perspective, it's a Schedule C profit and loss deduction, depreciation deduction. It goes over to Schedule 1 to your tax form, that's where business losses are reported. And from Schedule 1, it goes to your 1040 and brings over the business loss, which then is an above the line loss, not a below the line loss. And so it takes income on line 7, losses line 8, adjusted gross income basically becomes 0. You're done.
All right. And then
So we'll say that's the structure for buying it. Now, whether you have your own location or you need somebody like Aaron who's got a location, or has some land to put these things on, then you basically just get into it. Then it becomes more of a management agreement with a rev share.
Okay.
That's it. You turn it over to Aaron's entity as an investor. The rental income makes the nominal, the small payments on the debt, because the debt's financed at 0% with a very, very, very long term, so that it makes the ability of the asset to cash flow, not only to pay the debt against it, but also cash flow for the investor. Right. And typically we get these things where, it's going to be probably an 8 to 10, 12%. It's going to be a range. I mean, again, it's based on location.
Correct. And where we're currently looking is specifically where you're like your destination spots and worker camps. That's real big right now, especially with drill, baby, drill.
Well, the problem with oil. So oil's down right now.
I know.
It's oil's got to be, I think, at like $65 a barrel or something like that before that the oil companies are even but that's their. I have a friend in oil. They have a bunch of wells all through Texas, California, and whatever. I mean, they lost 1.5 million. A small oil company. They lost 1.5 million last year because oil price was below $65 a barrel.
Yeah, I know it's the right now it's at 65.20.
But like for your point, where you're up in Reno right now, the
Yep.
big move right now is they're building data centers, like
Yes.
100 new data centers a year across the United States for the next 10 years. And a
They're
lot of
huge.
these are in remote locations where there's no housing. So taking tiny homes, or there's some manufactured homes that can be bought that are already built, like they already have like 4 to 5 studios in the manufactured home themselves for
Yes.
workforce housing. You're deploying these things based on the worker will pay his per diem for his lodging, right? And
Yep.
so like this 5 unit one, 4 unit one that I can get from a manufacturer, a deal like that will pull in $12,000 to $15,000 a month just for one manufactured home. That's gross rent though.
Right. Right. Yeah. And I know those are. I mean, out here, we were talking about it earlier that you got Google, Tesla, Amazon, Switch, and some other big guys, but these data centers are huge, and this boom started in Reno a few years back because the land's cheap and there's a lot of it. and
Mm-hmm.
and the distribution centers out here, you got Walmart, Target, Petco, all the big distribution centers are out here because they moved away from California, because the taxes in California and all the regulations and just everything's more expensive in California. So it's only a 4-hour difference from the Bay to here. So they set up shop here, and now they're just transporting everything down this USA Highway Parkway that they built. Yeah, it's just going to be a boom out here for the next 10, 20 years for sure. But back to the structure, because we mentioned the sole owner, right, through an LLC, and then we also have the fractional type. So if I have,
Right.
let's say, 4 or 5 of my buddies that got 20 or 30,000, we want to put up, and what does that structure look like on the front end, and then for the taxes?
So basically, this strategy does not work in a partnership. It
Okay.
really, because the partnership rules with deductions sometimes can get a little shaky based on basis, right? So it works based on an individual LLC. The LLC and your partners, each LLC would own, say, 20% of the tiny home or manufactured home. And then we would just do what they call a co-ownership agreement. And that it's simplified.
Okay, so
There's
it's
not a
just
lot.
fractional based ownership.
That's
That's
it.
pretty,
Just
yeah. Okay. And each one has their own LLC. So he
mhm.
owned the 20th, his LLC, my LLC. Okay. Um, now, I mentioned this in while you were on the phone, but uh, timing now for this year, and then the length of time that this actually is going to be in place, like for future years. So the timing now, like how much time do we have left this year to capture
We
for?
probably have 30. We have until probably the third week of October to get your order in for a tiny home because they take about 4 to 5 weeks to manufacture. Um, yes, you can order them from China and it takes 30 days by boat, then another week in customs. And the product is not great.
Right.
So everything that I'm doing here, everything's manufactured into the US. So we're utilizing, real UL rated wire, electrical wiring, US outlets. The
This
problem with
company
some of
was
the,
actually built for disaster relief, correct? Which is another.
well, not necessarily disaster relief is what we came up with. It's based like this. The IRS requires you to place the unit in service in order to be able to get the deduction.
Correct.
So if we earmark it for disaster relief, it's considered placed in service because it's available and ready for use. We're just waiting for a disaster relief state or federal agency to say, hey, we want to rent this thing. We got a hurricane or whatever. So that passes the compliance part perspective of placed in service because where it's available for rent. And then, you know, if you don't have it for disaster relief, then we literally have to go do the septic, the water, the electrical. That could take a couple of months to get that set up.
Yeah.
Then it wouldn't be placed in service. So we earmark it for disaster relief when we initially buy it. Then that gives us time to go find a location.
Correct. Okay. So we have about to the almost the end of October if they to want to put a deposit down to get their tax benefit this year.
Correct.
Now, long game, you know, next year, 5 years. How long do you foresee, or is there even a cutoff for this particular tax code when it stops, or does it?
For the next 4 years, we have bonus depreciation. Bonus depreciation expires 100% in 2029.
Okay.
Then you're just going to revert back to accelerated depreciation under Section 179, which has a $2.5 million cap.
Okay.
And that goes up every year based on inflationary adjustments. So this year it's 2.5 million for Section 179.
Got it. Okay.
So
why is the code going to stop in 4 years? Or
that's what they wrote into that's this new tax law. That's the law. It expires in 4 years, and I don't think they're going to renew it because it's hard right now. We don't know what next administration is coming in after Trump's gone.
Got it.
And all these fancy tax things, if the Democrats come in, they will undo all of them. So your taxes right now, our taxes are low because of all the incentives. If they get in 2029, you can bet your tax bill's going up with no incentives.
Okay.
So you have to plan now. If you plan now and say buy more assets than you actually need for your tax year, you get to carry over the loss. That's called a net operating loss carry forward, and you can use those losses in the future.
Okay. That makes sense.
So let's say you only need, $1 million of tax deduction, but we structure it to get you $2 million worth instead of $1 million worth, and you do that $2 million for the next 4 years. Then the 4 years after these tax breaks expire, you still have the operating loss to cover you for the next 4 years.
Got it. Yeah, that makes complete sense, and that's very beneficial information for the listener, because after hearing 4 years, but if you have something we can carry an additional 4 years, the 8 years of no taxes would be.
So just take the example of 200 grand down for a $2 million tax break, right?
And
but you only need $1 million of it, right?
Yep.
Okay. Well, we just cut your tax bill by $600,000. What if you doubled up and put 400 grand down for $4 million in tax breaks through bonus depreciation, and we did that for the next 4 years? Now that probably that covers you 8 years in the future, right?
Yeah.
So you have, instead of getting a 200%, 300% ROI by reducing your tax bill, okay, you're only going to get 100%. It's just smart tax planning. Plan ahead for what's happening in the future.
Yes. That's and that's what we're doing here. But on moving forward, because everything you just said is, it's a lot to take in. You got super technical and some stuff, which, I'll have to rewatch to figure it out. But case studies, you've been doing this for 3-4 years. You are a CPA. You have clients that are purchasing these and that you're doing the strategy with. Can you share a few? You don't have to name names. Share a few examples of folks that have used this strategy recently and in the past.
Well, everyone who's used the strategy zeroed out their tax bill, other than the investment in the tiny home. So I have had I'm working on the tax return right now. One client bought, because he's very, we're talking 7-figure income. He bought 6 tiny homes last year.
Wow.
Okay. So that has zeroed out his, he bought 6 tiny homes last year. It zeroed out his tax bill. I mean, he's a part owner in an S corporation, so self-employed, but he had, I think, $2.8 million of W-2 income through his S corp, and then another $1 million plus distribution on top of that, and the other businesses he owns. So he had a total of, I think, about four point something million dollars in total income, and his withholdings. Just think about his withholdings were well over $1 million federal, and then withholding with this because he lives in he lives in California, so he's paying that other 13.3% state income taxes, and so he's looking at a pretty significant tax liability.
Right.
But with the tiny home structure, it's zeroed it all out, and he's going to get a full refund. Now, a smaller guy is W-2, $500,000 a year W-2 income, but $700,000 a year in his LLC business income. So it's like a combined income was like $1,220,230. He bought one tiny home last year, and this is actually a business partner of mine as well. We own a couple businesses. He bought one tiny home, placed it up in Tonopah, Nevada for workforce housing, and zeroed out. His withholdings from his job were $103,000 withholding. He was going to owe another $312,000 to the IRS because he had over 1.2 million in income.
Right.
So for
the gentleman that got a return.
Yeah. So for 125 grand, he bought a tiny home, $1,250,000 in depreciation. Okay. Which zeroed out his entire tax bill. He got a refund of everything he paid in, plus his $3,000 in tax credits for, his being married and 2 kids. Right. So he paid in 100 grand, but got $103,000 refund. Okay. And this avoided the other 312,000 he was going to have to pay.
Wow. That's beautiful. That's like, right. And this kind of segues into my next question. For people that are a little skeptic about this, might think it's too good to be true. What, as a tax professional, what is your response about that? People that are skeptical about it, because it does sound too good to be true.
It's not too good to be true because it's an asset purchase. If you go buy a G-Wagon, okay, let me just look at this.
There we go.
It's all in the news. It's in the news right now. Floyd Mayweather bought a G-Wagon for $1.2 million. Was that a personal purchase or a business purchase?
Business.
Right. What does Floyd Mayweather? A G-Wagon costs $250,000, right?
Yeah, $4 to $5, depending on the package.
Okay, but this package it was used was $1.2 million for a used G-Wagon because it had somebody's signature on it.
Limited edition.
Quantify that. The fuck value is at 1 point. That thing's going to lose money every year. And in 5 years, he's only going to sell it for probably $100,000, right?
Yeah.
Because the G-Wagon weighs more than 6,000, it's a very heavy vehicle.
Yeah.
He gets to write that depreciation off 100%.
Yep.
Because it's a business use vehicle.
I've used that.
The tiny home is no different. It's no different.
Right.
The assets, you can depreciate and write off 100% of an asset as long as its useful life is 20 years or less. That's the rule. That's the law. So
tiny homes, even though they're built good, I highly doubt that we'll be using the same tiny home in 20 years.
You know what? And I'm going to rebut that with a quick statement. Okay. The mobile homes that you see across, over in Mojave County and Kingman have been sitting in the desert getting beat up since the 1960s, and they're still usable.
Oh, wow. Okay.
Yeah. Okay. Meth Central across the river outside Las Vegas, but to say that
define usable, because it might be usable for them, not for me.
But what I'm saying is there's a lot of manufactured homes that were built in the 50s and 60s that are still in mobile home parks. I mean, they don't look great, but they're livable. It's habitable. Somebody can live in it. The tiny homes today, if it's built by a manufactured home manufacturer, I think they have to warranty them for 50 years. There's a
Okay.
50-year life on them.
Okay.
So,
I know we're running short on time because you have a 10 o'clock, but 2 more questions for investors that are thinking about doing this. What are some legitimate risks that they should be aware of, if any? Usually there's a risk with everything, but what are they?
look, if you think the strategy is too good to be true, then just pay your goddamn taxes. That's it.
Yeah, I guess the
Just
risk
keep
of
paying.
paying $200,000 in taxes or not.
Right. That's your choice. Buy an asset with dealer financing, put 10% down, get the leverage. It's an asset purchase. What can the IRS do? The only thing the IRS can do is say, we don't believe that you purchased this asset. That's the first letter you get. Please provide supporting documentation on this asset purchase. Well, it's not like going to the grocery store and getting a receipt. Okay. Your purchase agreement is your receipt.
Yeah. I mean, it has to be signed and
That's
sealed
it.
and everything.
Once you provide the purchase agreement, that's it. And I had that happen this year. IRS said, hey, we want documentation on this purchase. We sent the purchase agreement in, and then 3-4 weeks later, they released the refund.
Perfect.
Now, if you're a high income earner and you're getting tax refunds of like $2 million or more, okay, this is what a lot of people don't know. Any refunds processed by the IRS that are above $2 million require congressional approval.
Oh, wow.
Yeah.
Oh, so if the investor was to get back $2 million from the IRS.
Oh,
yeah.
I've got some clients that pay $4 and $5 million a year in income taxes.
Wow. That's amazing.
And this particular client doesn't want to do any sort of tax strategy. He just likes to pay his income taxes. Like, honestly, that's it. Like, fine.
Really?
Okay. Yeah.
He doesn't do anything. Okay. Wow.
Doesn't, but he's also doing $150+ million a year. So, I mean, I'm just like, he doesn't care.
Really affecting him much.
Not really.
And all right. So resources for folks that are interested in this. If y'all are out there listening, I have a link below that is going to allow you to book a call with us so you can learn more about this particular tax strategy. And Chris, before we go, what's your number one piece of advice for investors that are listening to this and considering this strategy? I mean, I think I know the answer already. I think we've already drove it home, but just to end it, number one piece of advice.
Expenses are not your friend. When your tax professional tells you to go out and spend more money on things and items that create expenses in your profit and loss statement, that doesn't help you. You're not bankable then. Depreciation is your friend, because depreciation, even though you can get to zero income with depreciation with a leveraged asset purchase, it's an add back to your financial statement. So you're still bankable. You still qualify to go get business lines of credit and all that other stuff. So that's the big difference between an expense and a depreciation strategy. Is a depreciation strategy zeroes out your income, but also still allows you to get bank financing.
Love that. Love that. That's the first time I've ever heard a CPA explain it to me. On my last one, he was telling me to spend more money.
Right. It's like
spend
more money on assets that can generate money.
There we go. Yes.
That's really the thing. But
yeah.
Tiny home's an asset that's going to generate rental income. Well, it's not. Tiny homes are not by nature going to appreciate in value. You know, maybe after a couple of years, if you anchored the damn thing and put it on top of a foundation and then called it a piece of real estate, then you'll see some appreciation. And that's also a strategy. You know, after you get through the first year of depreciation and you've gotten zero down, then you may look to put them on a foundation. Okay. So that now you get the increase with appreciation and just general real estate. So yeah, it's a multifaceted thing, you know.
Love it. I love it.
And I'm more than happy to help people walk through this. You know, I do free initial discovery calls to see if we're even a right fit. You know, I don't take people on if I got personality conflicts. I just don't take those clients. I gotta be able to work with you in a cohesive teamwork manner and listen to my advice. Some clients, if they don't listen to the advice, I let that client go. because it
Yeah.
just creates more work for me. And they're like mad at me because they're not listening to the advice when it comes to tax planning. That's like, dude, I told you 3 things. It's all written, documented. Do these things, and then we can help. But you didn't chose not to do those things. I can't help you at the end of the year. So,
Yep. I like that. And guys, just for a disclosure for me, this is not financial advice from me. Do your own research or book a call with the professional, Mr. Chris here. I will have some information below that you can do that. So, Chris, thank you so much for joining us today. I appreciate it. And I think we're going to be doing some big things with this opportunity in the years to come. And again, I thank you not only for helping me in my tax problems, but all the potential future investors that we're going to help as well.
All right. Thank you, Aaron, for having me on.
All right. I
Have a good
appreciate
weekend.
it. You too. All right, guys, you heard it here from the best. We are going to save you tons of money on your taxes. Click the link below. I have a calendar invite below that you can book a call and to get more detailed information. For this year, the time is clicking. We got about 3 to 4 more weeks that you could put down your down payment to start the initial investment and to get everything done so you could benefit from this year's taxes. If you're a high income earner, or even if you're, only make $100,000 to $500,000, it still can be for you. So don't wait. Click the link below and book a call today.